as a portfolio manager when he joined the company in 2007. Kwabena holds an MBA from the Paris Graduate School of Management, a diploma in financial management from ACCA, and a certificate in investment performance measurement from CFA Institute. He is currently a doctoral student in finance at SMT University, Switzerland. So, Dr. in Waking, Mr. Boama, welcome. Let us see you. Thank you very much. So, ladies and gentlemen, these are the experts on the panel, and I'm sitting in the couch with them to discuss the issues for today. We are looking, as has been said, on the updates of the debt exchange program and its impact on our pensions and the way forward. So we would do justice to the questions. Ghana's economy has been a very buoyant one. The history of Ghana's economic growth has been checkered. In 2019, we had a very strong GDP growth rate of 16.51. 2020, it fell to around 0.51. Then when you come to 2021, we picked up to about 5.36%, almost 5.4%. Even inflation as at 2021 was hovering around 9.9. And the CD was doing very well against the dollar. Enter 2022, all these strong economic fundamentals seems to have experienced some significant seismic disaster, leading to the collapse of most of these fundamentals in 2022. What has really happened? How did we get here? Where at this moment we need to go into a debt exchange program? I think at this point I'll ask Mr. Boama to lead us in this particular discussion. How did we get there? Oh no, Isaac. Isaac should be the Chief Investment Officer, please, because I see smiles on your face. Isaac, please, can you tell us, how did Ghana get here? How did the mighty fall? Isaac, you may have to unmute your mic, your phone. We can't hear you.
I hear you, sir. Great.
Yes, we can hear you now.
Thanks for having me on the call, and I'm grateful to be one of the panelists. And good morning to everyone. All right, so the question was, how did we get here? What happened that we got to this position? I'll keep it very short. Basically tracing our steps back in 2015 when Ghana had the 16th IMF program. Was an extended credit facility that concluded in 2019, thereabout, or 2018. But if you look at Ghana's economy, which is a lower middle income economy, we've had quite a bit of shocks in the last 3 or 5 years. It starts from the energy crisis, which cost us money to buy the energy generators. And that money means the money might have come from revenue or debts. So the first crisis is the energy crisis. The second, like we all know, was the financial sector crisis, which again cost us money to clean it up. By that, it means that depositors' money were assured. They didn't lose their money. This money must have come from somewhere. So that's the second one. The third one is the mighty COVID. That again hit us in 2020. Okay, then we have the Russia-Ukraine, or what you call a debt overhang in 2021, 2022. So in a matter of 2015 to 2022, we've had how many? Energy, financial crisis, COVID, and then the Russia. So 4 and 7. Now, ordinarily for a smaller economy like us, you're going to feel the pain. It's like a parent, it's like a family, a household where the father is taking ill, the mother is bed resting, the kid is not feeling well. It's going to stretch the financial of any household. All right, now to cap all of this in terms of the crisis, then you also realize that in 2018 to 2021, Ghana took a certain posture of using debt to spur growth. What do I mean by that? Typically, when you take debt, you are using it to generate a certain growth that you hope will pay for the debt that you've taken. So in 2019, in addition to the domestic debt, we went to the Eurobond market. We took about 2 billion 2019, 3 billion 2020, 3 billion 2021, 3 billion. These debts were being taken with the plan that is going to help spur growth, and the growth will generate bigger revenue, and the revenue will pay for the debts. That was quite clearly, without saying, that was the strategy of Ghana. However, as the accounts will say, Fofi and Tuata, once COVID hits, economic activity slowed down. Now you've taken debts. It's like you taking a loan to start a business, and then down in the middle, you fall ill. You still have to pay the debt, but the income that you're supposed to generate is not going to come. So in 2020, when the COVID hit, we were caught out. Now, just about the time we were trying to recover, again, you have this disturbance in the global economy, and that has compounded our difficult position. So to put it in simple terms, the crisis together with the debt strategy we took has not helped us to actually make much more meaning out of the debt that we took. So as a result of it, what we say is that we've taken too much debt, and so more than half of our revenue is being used to service the debts. And then the other half is being used to pay interest. So literally beyond interest and wages, everything else we'll have to go and borrow. Now conditions too are not favorable. Inflation is now at 50. How do you borrow at 50? So it becomes a very difficult conversation to have. What that means that we need to retrace our steps and recalibrate, as we say in our space, and then go again. So it's a combination of the crisis we took and the strategy of using debt to spur growth that has combined to put us in this difficult space. But let me say that just to emphasize the crisis that we face across the globe. Look, yesterday or so, Kenya was downgraded to B. Nigeria has moved from B+ to B-. In a year when oil has shot up, and we all know how Nigeria benefits from oil, but they now B-. So a lot of African names are going through this. What makes Ghana so peculiar is the internal crisis we've had, the energy crisis, the financial crisis, compounded with our debt strategy. That has put us in a very difficult spot where we now need to have a conversation of debt restructuring just to give ourselves some breathing space. So in a nutshell, that's what has caused us where we are now. Thank you very much.
Thank you for such insightful comments. Just a follow-up. There's been divided opinion in the country that the cause of our current situation or our woes, even though can be attributed somehow to the external factors, as you mentioned, largely the signals were all the wall, and that we did not pay heed to the warnings of experts that we're treading dangerously, and that, as someone joked, we are behaving as though the Ukraine-Russian war bombs are being thrown right here in Ghana, and even crying more than the Pope, or being more calculated than the Pope. Or as we say in our local parlance, we are crying more than the bereaved. What extent do you think our own management of the economy can be attributable, or mismanagement thereof of the economy can be attributable to the extent to which we have these challenges? Maybe let me call Kwabena to Mr. Boama to shed some light on this.
Thank you very much.
I'm sure Isaac would have loved to answer this one. But
if you want to be messy, you can pass it to him. He will answer and then pass it back to you. So, Mr. Isaac, maybe take it.
I'm sure my senior Boama has done the deal behind the scene. Okay, so I'll take a stab at it. So, look, things are very nuanced. I wish I could say we will take 50% blame, 70% blame. It doesn't work that way. Things are extremely fluid. So as much as what we've said that there's an internal challenge and there's an external, how much of it do you apportion becomes very subjective. And as professionals, we like to stick to and not move into assumption. But suffice it to say is that I think there are learnings we can all pick from this crisis as individuals, as managers of companies, as managers of a national economy, or as managers of a continental economy. We were perhaps a little bit too bullish. Nobody could have thought of COVID, and it happens that we were probably a little bit too bullish. And by bullish, we were probably too optimistic, because when you take on debt, it suggests you believe in yourself that you can generate a certain revenue to pay for the debt you've taken. So perhaps we were a bit too optimistic, and as families, as companies, as economy, we need to always make decisions, bear in mind that the worst case scenario these days could be very near to you. So I think, and it happens to even me as an asset manager and KB as somebody who's running, we can be bullish. Let's take on this project, we will get it done, and tomorrow a crisis will expose you. For an economy like Ghana, we are very much, it's like the bone shaker, just a little pothole, and everybody in the car just moves from one side of the car to the next. So what I would say that perhaps looking back, if everybody look back, we were a bit bullish, and maybe going forward, we will need to be a bit more toned down. It doesn't mean we shouldn't be ambitious, but we need to juxtapose it to our placing in the global economy, just to make sure that we don't overstretch ourselves. So that's what I would say. Perhaps we're a bit too bullish.
Thank you very much. And I like the part you said that there are a lot of learnings for us all to pick up. So I'm sure everybody, both the average Ghanaian and governments, have picked a lot of cues from what has happened. Now, with all these that are happening, what has been the impact on investments generally? How have our investments suffered? Now we're coming home, because if the chickens have come home to roost, how has all these impacts, or the scenario that have been narrated by Isaac, impacted on our investment, especially the investment environment in Ghana and finance markets in Ghana largely? So, Kwabena,
thank you.
I invite you to discuss this. Yeah.
Okay, and thank you, Enterprise, for having me on the call, and good morning to the listeners once again. I'll take it from this angle. Two major macroeconomic indicators hit us on our financial or investment market, which the central bank sought to respond to. And that has been the genesis of where we are with respect to our investment of financial market. The impact of the happenings that Isaac spoke about caused these two major indicators to rise significantly. At a point, we had our currency depreciate by about 60%. We also have seen inflation continue to rise significantly. In fact, last year, inflation closed at 12.8 or so percent, and we're currently at 50.3%. Now, these two indicators were what gave rise to interest rate movements from the beginning of the year till now. Now, interest rates have shot up significantly, also from around 12% end of last year, and we are currently seeing interest rates between 32% and above 40%, even some at 48 or 45% on the bonds market. Now, so in the various financial segments that we have, where you have your money market, you have your fixed income, and then you have your equities market, just for the benefit of our listeners. So the money market are your short-term investments, like your fixed deposits and your treasury bills. Now, these respond quickly to interest rate movements. So Bank of Ghana, in fighting the currency and inflation, increased the policy rate, and that led to the rise of interest rates on a regular basis. So the money market, with your short end of the market, rapidly responded to the interest rate movement. So you saw treasury bill rates also rise quickly from your 12% now up in the 32s. Then also fixed deposits from banks also went up. Now, on the fixed income side, these are bonds. And this is where you lend to corporates or you lend to the government for a longer term. in between more than 2 years. In Ghana, the longest we have is 20 years. Now, the fixed income market has an interesting reaction to interest rate movements. Now, when interest rates move up, the price of fixed income instruments actually move downwards. And that is what you use in determining the value of your investment or your fund. So as interest rates began to move up, then it means that your bonds or any fund or portfolio that had investment in fixed income then began to depreciate or decline in value. So we saw our bond market record high yields or high interest rates, but the bond prices dropped from 100 to the 40s, 50s, and then the 60s. On the equities market, because interest rates on the short end treasury bills have become more attractive, we also saw a lot of investors exit the equities market to pursue better returns on the treasury side. So you saw a negative impact also on the equities market. So as far as investments are concerned, it's a mixed reaction, but a larger impact on the equities and then the fixed income side. Have seen a lot of values over the period. The other interesting thing that has happened is that we've seen opportunities on offshore or alternatives, which is beyond your usual financial investments, actually pick up because we've seen some better returns in these areas. So that's what has happened to our investment and financial markets. Thank you.
Thank you very much. Thank you very much, Kamna, for those very insightful comments. Now, a certain terminology has assumed currency within our financial lexicon lately, and it's called debt restructure. Somebody said debt structure. Somebody mentioned it last time, and I laughed over my head. What at all is debt restructuring? And what is all about this debt exchange program? First of all, what is debt restructuring? When you talk about debt restructuring, debt exchange, and debt whatever, what are we talking about? Governor, please take it up again because where you were really airborne on this subject. So please take this one and land on it. Thank you.
Right. Okay. So debt restructuring, and let's make it very simple for our audience. Or it's basically we've reached a place as a country where the facts on the ground is that we are unable to pay our debts as it stands. And like we'll typically do if you're in a business, you borrow from a bank, and at a point you're not able to pay your debt, the bank will come in and sit with you and say, how else can we rearrange this loan that we have given you so that you can continue to function as a business and then also pay us? So the debt restructuring is looking at our debt as a country, as it stands, and our inability to pay that debt. What can we do as a country to enable us continue to run as an economy and as a country, and then still pay the debt? Now, the unpleasant truth is that the debt position as it stands now is too huge for us to continue to service and then pay. So what it means is that something has to be done about the size of the debt and then also the obligations under the debt. And the obligations here means the interest rate that the government has to pay in respect of the debt that is outstanding. So the debt restructuring is looking at how do we repackage this debt that we are owing as a government so that we can be able to pay this debt and then also ensure that we run as a country. Two things is likely to happen. One, it's either they extend the period for which you're supposed to pay. So you're owing and you're supposed to pay next year. You don't have enough money to pay next year. So we'd say, okay, then pay over a 5-year period or a 7-year period. So we extend the period with which you were supposed to pay the debt or the loan. Then the other way of doing this is also the interest rate that you are supposed to pay on that debt or instrument. And that one too is usually revised downwards so that it becomes easier, or it becomes feasible, not easier, feasible for the government to be able to pay the debt. The other one, which is very common and we've all heard about, is the haircut. And that is where you actually take the principal amount that you owe and reduce it. As to what percentage you reduce it, that will depend on the negotiations and what you do with the people that you owe. But that's how the debt restructuring is. So we are taking our existing debt, which we are not able to pay, and then we're looking at how can we pay at the same time run as a country. And we do that by extending the maturity date of the bonds that are existing or the debt that are existing. We reduce the interest rate on it, and then also you reduce the principal. But we've heard our Minister of Finance and the President say that there will be no haircut on the principal. So your principal remains the same, but the amount of interest and when they will pay has changed. So that's how the debt restructuring is.
Thank you very much for that. And you made a very important point. When you do analogies with what the bank would do typically for someone who owes, that they will sit with you and tell you that you owe so much, and they will enter into some arrangements for you to pay. But it appears that participants and more so investors do not think that the bank, in this case, government of Ghana, has had that level of thorough sitting with participants. Even though the program is being described as voluntary, it appears that it has been rather quite sketchy in terms of the level of quantum of engagement. More so, the signals have always been on the wall. We have always been told that we were breaching acceptable thresholds when it comes to our debts, and our debts were increasingly becoming unsustainable. So just as one of our participants told, and let me put this question to you. He asked, and I think this is the name here is DA0073. My question would be, why should we investors and pensioners, does the citizens, suffer from the mistakes of the government? And another one said, so the root of Ghana's situation is due to the debt strategy. The government took, and not necessarily because of COVID and Russia-Ukraine war. Ghana had some monies from external partners. Ghana had some monies from external partners during the COVID, and government collected COVID levy to manage the crisis. Lack of a decisive strategic decision from government resulted in a reactive approach to the consequences of the Russia-Ukraine war. So from these two of our key participants, their argument is that largely government has been aware of the challenges, and they think that we are simply being made to suffer for what government has not done well. What is your opinion on this? Especially given and adding to the fact that the others complain that engagement levels have not been that good. I think I will ask Isaac to share some light on this, and then the governor would add a little bit.
I'm sure after this program, I need to go and see Kwabena, what trick you use or you.
I'm watching your body language, and as I see your faces, it signals to me that you're prepared to accept a transfer of question. So I'll pass it to you.
Anyway, so the question, just to unpack, is the debt strategy of government and the engagements afterwards. Okay, so this question cast my mind back to 2018 when the financial crisis happened, and I remember our good friend, mentor Alexa, who KB succeeded, asked a question whether it is morally right for government to fund investors whose money were in this defined banks and collective investment schemes when these people were making their money. They didn't share with the states. And at that time, the consensus was that it behooves on the state to protect these people. And so for all the people that invested in all these collapsed banks, all these mutual funds, the government or the states, when I mean the states, we ourselves with our revenue pay. But because the revenue was not enough, some of these amounts were borrowed. I think we cannot hide away from that. If people invested in spaces, when you got bust, we agreed that, okay, the state should fund this. This funding was not from revenue, it was from debt. Okay, so that's that. We need to put that into perspective. The other bit really has to do with the back to the debt strategy, as to the debt, what they call the mix between domestic and external debt. If you look at Ghana's composition, about half of the debt is external, half is domestic. What that means is that it makes us vulnerable to external shocks, as we've seen. Now, the issue which is government will say that external debt is cheaper compared to the domestic debt. So there was that Eurobond spray of using, because to be honest, the tenors on the Eurobonds and how much you pay is way cheaper than the domestic. If you take government interest payments, domestic is about 75% of our interest costs, and external is this. But like I said, perhaps we were a bit too optimistic and never thought of a day like this, and that has caught up with all of us. So that's just by that. You can obviously say that you probably might have toned down on the bullishness, because crisis is always in the corner waiting for you, and you hardly go through 2 years without facing a crisis. So perhaps we're a bit bullish or overambitious in some of the things we were trying to do. Now, in terms of the engagement, I think, to quote the Deputy Minister of Finance, they wish they could have engaged us a bit more thorough than what they've done. So again, that's a concession from the issuer that intensive engagement was lacking. That has been admitted by at least the Deputy Minister of Finance, that perhaps they could have done that. I guess for us pension funds is, what's the way forward? Okay, we have an asset, and I probably want to spend a bit more time. What's the way forward? If you look at the pension industry over the last 12 years, the growth in the fund.
So Isaac, we'll get there very soon. Somebody said, I'm giving you Sakura and you're touching your hair. We'll get there. we want to follow the issues in some order. Now, as Kwabena said, you owe somebody or owe the bank decides to engage you, and they want you to restructure your debt and through some arrangement. And that has been the language that the Minister of Finance has spoken to us, all investors, over the time. Then all of a sudden, the language changed to debt exchange. What is that also? Why are we debt restructuring and debt exchange? What's the difference between these two terminologies for the average investor?
So, maybe.
Okay, so the debt restructuring, yes, is the umbrella framework within which we are looking at how to solve this problem of our debt and make sure that we can run as a country and still be able to meet our obligations. Now, how to go about it? You can either look at readjusting or editing or amending the existing bonds that you have. For example, the government had issued a bond that matured in 2025. You can say that the 2025, which has an interest rate of 20%, is going to reduce the rate from 20% to say 5% or 10%. That's one option where you amend the existing bond in issue. The other option is to actually issue fresh new bonds or fresh new debts, and then say that what you have currently, bring it to me, and then I'll give you these new debt or bonds under a set of new terms and conditions. Now, one of the considerations from the director of the domestic debt, debt management desk at the Ministry of Finance, said was, our current number of bonds in issue is more than 60, which is a lot. Now, in going through this debt restructuring, they also sought to try and restructure the capital markets with respect to the number of bonds that have already been issued or debt that has been issued by the government. And that's how come they decided to compress all the bonds, the existing bonds, or what we call the old bonds now, and then say, surrender the old bonds, and then we'll give you new bonds, 4 new bonds. And I'm sure we'll talk about the new bonds. But the debt restructuring is the framework where we sit and say, how do we look at our debt or our loans, and then how do we look at paying this going forward? And the exchange is the medium of how we will do this, which is bringing your old bonds and then we giving you new bonds for us to look at the way forward and ensuring that we can continue with obligations as a government and then also continue paying our debt.
Okay, thank you very much. And with this debt exchange program, and then for our participants, you are encouraged to send your questions, reviewing them as they come, and if they relate to any of the topics that we are discussing, I will ask them, and then I'll roll them over as we go through. Now, we understand that there's a deadline for this debt exchange program set by government, even though it's voluntary. And people are also concerned that on that deadline date, what values on our bonds are being exchanged in this package by government, and why? Yeah, you've been quiet. You can take this briefly. Then I'll come back to Isaac, who says Kwabena has bewitched me. So yeah, please. You can take this briefly, and then
yeah. Thank you very much, and good morning to all the members online. So the question is, what is the value of the bond that is under consideration for the exchange? So according to the briefing that we had, the value of the bonds under consideration will be the face value of these bonds as at 23rd of December 2022. So how do we value these bonds? We value these bonds by accruing the interest thereon. So for most of these bonds, for the past 6 months that we held them, coupons have been paid. But we have portions of the coupons that have not been paid up to 23rd of December. And so what government is saying is that the coupons before 23rd December will be paid. The accrued coupons, which is the interest, will be sacrificed. And so to answer the question, basically, it's the face value of the bond without the accrued interest that is under consideration now. Just to add a little to that, the Chamber of Corporate Trustees, of which we also belong to, is trying to work with government to look at how this position will be revised to make it a bit more palatable for our members. So members, we empathize with the situation. Be rest assured that we are working together to make sure that the bitter pill is made a bit sweeter for us. Thank you.
Thank you very much. But Isaac, is this pill not too bitter? Now you have an investment for so many years, or two to full bond, all that. And is that some kind of debt exchange program that kind of bitter pill, is it easy for us to swallow?
Dr. Gawande, obviously it's a bitter pill to take. It's not something that any of us will wish for anybody. And let's all bear in mind that all the people on this panel are also pension contributors. So here we are speaking as professionals and also pension contributors. So it's not something that we really would want to. From our calculation alone, if you look at this, how much we are losing next year in terms of coupon payment that we are forfeiting using the existing bonds, we probably the industry probably will forfeit about 8 billion or so. So that goes a lot to hit everybody. It means people are less richer than they were a few months or a few years ago. So quite clearly, this is a very frustrating point for everyone, including even Dr. Gavani himself. What can be done? I think the trustee chamber is engaging the Ministry of Finance to see what concessions government can give. Even the workers' union are also doing the same. We are all praying and hoping that there could be ways to mitigate the impact that pension funds will feel throughout this exchange program. So I think from Stanbic to IC to enterprise to your school self, this is not palatable news to share with anyone. And we can only hope that negotiations and conversations with the issuer will bring some, will yield some fruit for all of us. That's what I'll say for now.
Thank you very much, Isaac. Now that you've gone into some specifics, for the average pension contribution. Yes, sir.
Maybe just to put in context in terms of the impact with the new bond that will be given to us in exchange. I thought there was a question that will cover it, and I didn't touch on that one. So for all the bonds that are issued by government.
In fact, that's what I wanted to ask, actually.
Including the ESLA and then DACHI, which were issued by government. They are putting all of them together. And then they are going to give you 4 different bonds out of that. So, for example, if we held, say, 20 million bonds in DACHI, we did 30 million in ESLA, and then we had 50 million 2-year, 3-year, 5-year, 7-year bonds. All of them will be put together, and that becomes 100 million. Now, this 100 million, the government will take back these old bonds, and then they will give you 4 different bonds. Now, the 4 different bonds, we have the 5-year, the 7-year, then you have the 10-year, and then the 15-year. So you have 2027, 2029, 2032, and then 2037. Now, they are going to split your new bond into 4. So when they take the 100, they will split it into 4. They will give you 17% for the 2027, 17% for the 2029, then you receive 25% for the 2032. Then 41% for the 20. Now, each of them will have different characteristics, but for all of them, what is clear is that for the year 2023, there will be no interest payment for each of these bonds that you will hold. In the year 2024, the government will pay 5% interest on all the bonds. And then in the year 2025, till the last one matures, the government will pay 10% on the bonds that you are holding. For the 2027 bond, they intend to pay half of the principal in 2026, and then the second half in 2027 with the maturity. Then for the 2029, they will do same. They'll pay half in 2028 and then half in 2029. Now, for the 2032 bond, they will split the face value of the principal into 3. They will start paying 1/3 in 2030, 1/3 2031, and then the last one in 2032. And then the 2037 one, they also start paying from 2033. They will split it into 5, and then they will pay 1/5 till it matures on 2037. So when this debt exchange program happens, we will no longer have the old bonds as pensioners. but then we'll be giving fresh new bonds, and these are the terms. And we'll have only 4 bonds in existence for all government of Ghana issuance. Thank you.
Yeah, thank you very much. Now, what bothers people's mind and what is getting people confused is that we have a National Pension Regulatory Authority which has given certain investment guidelines, which more or less mandates the typical fund manager to invest about 70% of pension funds in government instruments. So more or less tying our hands to it. After putting this much into government instrument and supporting government largely in terms of its domestic funding, it appears that the golden egg, that is the hen that is laying the golden egg, is now being caught and slaughtered. Literally, that is what the impression for all pensioners are. In fact, one participant just asked, and I want to read that question, and that is Daji. Daji says, there have been suggestions that fund managers and investment bankers find alternative safe investments other than government bonds to invest in to make up for the losses. Is it a viable option? Now, my question is, having listened to all these debt restructuring and debt exchange program, in quantifiable terms, what is the impact on pension funds in the present and now? Yes, Kwabena, you've mentioned the different types of bonds and the kinds of coupons that will be earned on it. Next year, there'll be 0 coupons. That's all well said and done. What is the impact? What is the hope of the pensioner who is going on pension next year, next 2 years, next 3 years? Who's and in light of this, the spiraling inflation we are experiencing in the country, what can you say to the average pensioner who is listening to you? How is this going to impact people, all of us, you and I, now and the future? Kwabena, even though you are not smiling,
Okay.
I want you to take this one.
I mean, I'll just take a cue from earlier. Isaac made a comment about that. I mean, the impact is there. I mean, on the numbers guesstimate, we're looking about loss of interest about 8 billion, which is significant. Beyond the loss in terms of interest on what we kindly hold for our schemes and as pensioners, what we anticipate will likely happen going forward is the drop in interest rates and a possible lower inflationary regime going forward. So even though we would have lost significant volumes in terms of absolute amounts and the kind of interest rates that we were enjoying on our pension schemes and our retirement plans, once interest rates decline and inflation follows suit and we have price stability, we believe that we are likely to have a financial market or economic market regime where the current rates on these new bonds will be still attractive, prevailing as we near our retirement period. For those who are retiring in the shortest possible time, 2023, 2024, 2025, those are going to be the hardest hit because the drop will be very sharp. But those who are going to retire later on in the years, we will have a recovery period that will make our landing much more smoother or easier to bear than the immediate ones. So it's the loss of monetary value of what we are earning with or we are exiting as a pensioner that we are going to experience, given where inflation is and where prices are now.
Thank you very much. Isaac, at the point I stopped you when you were going to some of the specifics, and I can see from your body language that you have a lot of data to share with us in terms of the impact of this debt exchange program on our pension funds. And for the average listener and every pension contributor, we want to know what are we talking about? What is this animal going to do to our money and our retirement? Please shock and awe us with the findings.
Okay, so thank you very much. I guess on the personal level, most people want to know what's going to happen to the money, the statement, the value of my pension that y'all sends to me every month or every day. And per the assurances from the ministry, per the debt exchange program, outside of the accrual interest that might be wiped off, people's nominal value remain intact. So I think we should just put it across that today, whatever value you have, bearing the accruals that you need to write off, it's largely intact. Your capital is same, largely. Okay, so what we are really referring to is coupons that you are supposed to receive in 2024, 2025, i.e. the growth in your pension assets. And like KB said, that growth will slow down because the income that is coming on the government paper will be lower. And also, if inflation trends downwards, then that means that naturally the economy will be lower. And let's say this, that pension assets, it is good if interest rates are low, because then the market value of the asset you hold goes up. So it is even in our own interest that inflation comes down and interest rate comes down. That's so well and truly. Let me say there that the asset that I hold today largely remains the same. In fact, when you look at the nominal value in exchange, in some pension funds in nominal terms may even go up because some of the bonds were bought at steeper discount, and government is changing the bonds 100 for 100. I don't want to go into the technicality, but after the exchange, nobody's worse off. What's going to happen is that the growth that you would have had because of high interest rate will slow down, so that people on the call will be at least assured that whatever money that you'll show to them has not gone missing. Now, going forward, what's the impact on the pension assets? I think the biggest impact will be the pricing of government bonds. In terms of even from the auditing perspective, there may have to be allowance on that. So government bonds pricing will change. We may have to probably take on additional risk to make up for whatever shortfall that will come from the income that we'll no longer have access to. So those will, so just to summarize again, one, your position as of today largely remains the same. Two, the growth in your pension assets will come down. Pension assets largely have been growing around 25-30% on the back of high interest rates on bonds, which was hurting the economy if we really will be honest with each other, because high interest rate doesn't help anybody. So the growth will slow down. Maybe instead of doing 25% year on year, we'll probably do 10% or 12%. So that is a real pain point, that our growth rate will slow down because interest on government bonds has come down. So that's, I would like to just assure again, whatever value you have today has not been touched. Your growth rate will slow down. That will be the immediate impact. I want to shy away from going to the technicalities just for our brothers on the call. Thank you.
Thank you. But I just read through one of the questions. It appears that even though the nominal value will not be affected, the real value of the monies will have gone down, because now in basic economics, we're told that investment should be equal to the risk-free rate plus a premium. Now, look at where treasury bills are, look at where inflation is, and look at the kinds of returns you are going to make. It means that even though your nominal value would have been saved largely, the consequence and the reason why we invest and save money for a rainy day is to make sure we maintain the value of that particular money and gain some capital appreciation. So largely you could have saved your money, but you can't do exactly what you want to do with it. So what is the way out? Yeah, I want to ask you this particular question. Now, a lot of others have been asking, how is enterprise? I went through the questions that the listeners have posed. Some are asking about what will be the impact on enterprise trustees. And one person asked whether enterprise trustee as our corporate trustee will be sitting there and looking at things going this way. What are you doing? So first of all, how are our corporate trustee enterprise trustee going to survive this? Number one. Two, what is the way forward from a corporate trustee point of view? And three, how do we get a better deal from government on this debt exchange program? Is it a fait accompli? And then, yeah, I'm unpacking you. The fourth one, are we going to sign to the debt exchange program voluntarily by the deadline?
All right, thank you very much for the questions. Loaded indeed. So I'll try to take them one after the other. And so the first question that has to do with what we are doing as enterprise for our members. So I want to add that we picked up the signals earlier. And so we're working with our fund managers to try to restructure and diversify the scheme assets. And so earlier on, we wrote to our members and then we told them that we needed to diversify because our securities were exposed only to the cedi. And so we tried to do some alternatives. We talked about the new gold, we talked about global equities, African fixed income, and also increasing our exposure to Eurobonds to diversify the portfolio holding so that any event like what we are experiencing will have minimal impact on the scheme. So over the 10 to 12 year period that we have run the schemes, we have realized that diversification is key and we need to be able to work on that. So together with our investment committee and then the board, we tried as much as possible to do that. But notwithstanding how the turn of events has actually happened. So members, be rest assured that that diversification process will continue and we'll work with our fund managers to be able to do that. Two, we also continuously engage our fund managers to see how best we'll be able to manage the rest of the portfolio not directly affected by the debt exchange program to get some good and decent returns to mitigate the impact of what we are talking about today. So that work is ongoing, and part of this program that we are having is in that direction. We work together as one. We also will continue to engage our members because we have a fiduciary responsibility. These funds are not ours. They are yours, they are mine, and we need to be able to engage so that we bring all of us to speed as to what is happening. As mentioned by Isaac earlier on, things are quite fluid, and in such situation, continuous engagement is very key, communicating the right information and helping members to understand the impact of whatever that we are talking about is key. And this program is actually aimed at that. Then also together with industry key partners, and then also the chamber, we continue to engage the regulator, the NPRA. We continue to also engage the Ministry of Finance through one of our engagements. We made some proposals for the ministry to look at the situation of pensions, and then also to try as much as possible to have a fresh look about the impact of this debt exchange program on pensioners. And so that is something that we continue to do. But as a chamber, as the chamber continues to engage, the chamber needs technical and legal advice, which is also being sought to ensure that we do not only come from a position of feelings, but we also look at the technicalities involved and then the sound advice that we need to be able to receive, to be able to properly engage government and the NPRA on these matters are not left behind. And so that is being done as your trustee to ensure that we minimize the impact of the debt exchange program on members' fund, including ours. Now, as a company, I think there was a question that was asking how that will impact us. In fact, we are in it together. When the fund grows and prosper, we also do grow and we prosper. And so when the fund is not growing as anticipated, and as has been explained, especially for 2023, where we do not have any coupon payment coming through, then that becomes a concern. And we are affected as well, because that growth rate that you would have enjoyed will have rubbed on us as well as a business. And so that is impacting us significantly. And even for some corporate trustees, as the engagement to the regulator revealed, who had taken positions in government securities are also affected. It means that these securities will not be available in the short run to support our businesses. And so that is how it is impacting us as a business. Then the question is whether we are proposing that you accept or we accept or we reject the offer since it is voluntary. In fact, the advice that we have received is that we need to reconsider the positions. The current position of the debt exchange program as proposed by government is not palatable. And so that we, together with the Chamber of Corporate Trustees and other trustees of the government schemes, and also the Securities and Exchange Commission industry players, are saying no to the proposal. We believe that there is the need for a review of the proposal to make it at least a bit more palatable for us. And to that end, we have actually sent some counter proposal or enhanced proposal for the ministry to consider, for which we are waiting for the outcome. Now, the question about the deadline, what do we do about the deadline? That one too is being addressed. And from the Chamber's perspective and an advice received from our legal counsel, it is advised that we seek for extension so that we'll be able to properly engage members. Like I said earlier on, it is your fund, it is my fund that is going through the program. It is not the corporate trustees, it is all of us, our fund. And there's the need for us to be able to engage, and there's the need for us to be able to understand what is going on, and then to be able to holistically reject or accept the amended proposal that will be put forward by government. Even though the earlier engagement did not show any signs of government conceding to our request, we believe that when we pool our resources together and we come together as one and we push the agenda, we'll be able to achieve the results that is anticipated. So members, I think at the end of this, we will do some poll, and then we will expect to hear your views and your stance as well, because we are actually representing you. Whatever that we are doing it because of you. We empathize with the situation, but we also understand that if government does not do this, the economy is going to be in deeper trouble. And if that happens, it means that all our investment worth will be lost. But with this program, maybe there will be an upside, all things being equal. If market confidence is restored, interest rate comes down, inflation comes down, then we will see some value in the bonds that are being proposed to us. So once again, I think there is some deep thinking that we all need to do, and then to be able to come to a consolidated position on this. Thank you very much.
Thank you very much, Yao. I mean, you've covered a lot of ground on the subject, and as usual, you are always a very, very consensus discussant when it comes to matters of our investment. Now, I want to read one question from Mr. Obed Asari. No. Yes, it says, no, that one. One person was asking about, I think he was asking about the mark to market and how will that affect their investments in the pension fund, whether it will mean a haircut or not. And I think that once the questioner has introduced the issue of mark to market, whether the valuations would, and looking at what guidelines and instructions SEC has given, is that not already causing a significant challenge on the pension contributors funds? First of all, what is mark to market, and what is the impact of that on our pension funds? Are we following through with that? Maybe let me start from our fund manager first, then I'll get to Yao. Isaac is smiling, so please take it.
I love to take it after Yao because he is the accountant. So
no. Mark to market has several definitions when it comes to finance, investment, accounting, and other. Now we are now talking of investment, yes. And it's in your court. So I'll come to him. He also talks that.
So let me just explain with a very simple thing that we are all used to. Let's say you buy. Basically, I'm trying to explain what mark to market is. So you buy a car. Let's say the car is worth 1,000 Ghana cedis. That's how much it costs you to buy the car. Now, there are two valuations largely that people use, which is mark to book or mark to market. Mark to book, basically, so back to the example, I bought the car 1,000 cedis. That's my cost. So you record it 1,000 cedis. And based on interest is earning on the car, he accrues the interest on top of the 1,000 cedis. That's what is called mark to book. That's exactly what he gave out, and that's what he's receiving. Now, when you come to market, the difference is this. The car that I bought at 1,000, every day, because of technological advancements, the value of that car keeps changing on the market. Okay, so once you bought at 1,000, maybe tomorrow there's electronic car. So all of a sudden that car is 800 cedis. And so the market value of that car is 800 cedis. What SEC did with the collective investment scheme is that, look, because people come in and out every day, the value of the car, price it to market so that everybody is protected, which is the mark to market. That's what happened with the SEC one. Now with the pension fund, the nuance is that, and I will probably forcefully argue, is that the pension fund is almost like you only have access to it when you're going on retirement, especially with the tier 2. So a mark to market means there's a swing. And from the perspective of maybe the contributors, that swing is not necessary because these are not an open-ended fund like the collective investment scheme. So there's that argument is debatable, but I don't want to bring that debate here. But what I'm trying to do is that mark to market basically is, yes, you bought the paper, but in town, because market keeps changing, the value keeps changing. When we were in good times, these bonds that we bought, some of it, the value was higher than the price at which you bought it at. And in bad times, the value goes down than the price at which you bought it at. So that's basically what it means by mark to market, mark to book. As to whether we should adopt mark to market or mark to book, I think it's a debatable conversation, and the regulator himself has not firmed up on its position. So that's what I'll say so far.
Okay, thank you very much. So yeah, some of our investment are collective investment schemes. And even so, when SEC gives that directive, there will be some impact. I can read from some of the participants. They want to know this mark to market, how has it affected our pension funds? And if any, will the debt exchange program on top of the mark to market not be a double whammy of challenge for the average pension contributor?
Yeah, we want to take that.
Yeah.
Yes, this for you, please.
All right. So I would say that the mark to market, mark to book, which are two types of valuing a security, is actually based on the intention that you have at the time of buying the security. So if your intention is to buy and sell, then marking to market is the preferred method because you want to sell. If the intention is that you want to hold the security to maturity, then the standard says that book it as such. So you accrue the interest, and that is a fair way of looking at that. On the schemes, we have some of the assets that are marked to market. When you talk about equities, for instance, there is a market for equities. So all the equities that we purchase are really marked to market. So the market price determines the value that we give to members. And the collective investment schemes, until recently that we're looking at the underlying investments, were also being considered at fair value, because every day the fund managers were giving us the price, and that price is what we were recognizing for members. So now that we've seen that most of these mutual funds or collective schemes were also not marking to market, but they were also, valuing it based on mark to book or holding it to maturity and accruing the interest, then the impact of the decision by SEC directive that they should mark to market certainly will affect the underlying assets, and therefore the value that they will give us, which will also feed into the pensions scheme. But fortunately, equities and mutual funds are very small in terms of the percentage holding. Now we come to the government bonds and securities, which actually is the largest, or in terms of proportion or percentages, is the largest of the assets that we are holding. So then a decision to mark to market over there will equally have a significant impact on the values of members. When I was having an earlier conversation with Isaac on this, Isaac, remember you mentioned that the market is now in the barbering shop. So today we do not have any market values for the government bonds. It's like we are now trying to wait and see the outcome of the domestic debt exchange program, and then its impact on the values that investors will place on these bonds, if that should be the way forward. So certainly we will, and he knows my passion about it, that for pension funds that we have information, we can actually match the assets and then the liabilities. And if you can match the assets and liabilities, then that can afford you opportunity to plan. The reason why you are marking to market is that you will not be able to have liquidity to, honor members' request when they need their funds. And therefore, you want to use the market, because you can go to the market at any time, sell whatever security that you are having, and then meet that requirement and ensure that that loss, if any, or that gain, if any, is equally distributed for the members. But if we could do proper asset liabilities matching, then that might not be very necessary for pensions funds, at least on tier 2. But we also have another set of our pension funds that behaves like the mutual fund. That is our tier 3, where in addition to the vesting rules that we are having, and then also the fact that it's a retirement fund, we see in difficult times members setting aside some of these vesting rules and they're running to the fund for liquidity or for payment or for benefits payment. And when that happens and we do not have enough liquidity, then we are forced to go to the market. And when you go to the market, there could be losses. But you agreed with me that it will not be fair for you to take your book value and then the existing members absorb the losses on the account. And so if there is any discussions on the mark to market from where we sit as fund administrators, we are looking at it from the tier 3 perspective. And we will say that let us, agree, these are indeed pension funds. And this whole three-tier pension system came into being because pensions were considered very inadequate. The plight of the Ghanaian pensioner was nothing to write home about. And so we cannot treat our tier 3 as an emergency fund for which we need to mark to market. Even if we want to do that, there's a need for us to restructure or maybe redesign the product so that we can have a portion that can respond to the needs of members and a portion that could be locked up for retirement. And if we can do that very well, then probably maybe we can have basis for marking to book. Otherwise, mark to market means that you have a market haircut and then you also have the domestic debt exchange haircut to deal with. Thank you.
Thank you very much for concluding on that note. So it brings a lot of clarity. Now, in terms of crisis, usually you see a lot of finger pointing. Jamil Amponsa, one of our listeners, is asking this question. It says, the 2020 financial statement of enterprise trustees indicated that 63% was invested in bonds. Why so much invested in one investment?
Hello?
I think we
Hello,
lost
Dr.
Doc.
Gamade. Yes, I think he's having some technical challenges.
Hello, I can hear you now.
Okay.
Sorry, Dr. Gamade, I think I lost the connection a bit. Would you mind repeating the question for me?
Okay. I think we have rather lost Dr. Gamade.
I thought I lost the.
Yes. So we'll just take a question here whilst we wait for him to take over again.
That's okay with me.
Yes. So there's a question here. I think Yao can answer that. What impacts will this debt restructuring have on my personal pension? So this also goes into personal pension. I think we've spoken about the Provident Fund and then the Tier 2. This is about personal pension. Will this affect my personal pension with enterprise trustees?
Yeah, the direct answer to that question is that as at now, the personal pension scheme is considered as a group scheme, and therefore what we are discussing affects the personal pension scheme. We have constituent funds under the personal pension scheme. We have some that are conservative that are actually looking at preserving members who are nearing retirement fund. And until recently, the economic theory has been that government is the safest and the largest employer, and therefore, if you are looking at safety, you run to government. But unfortunately, as it is now, government debt sustainability has become an issue, and therefore the effect of this program, all things being equal, will affect personal pensions as well. But something that we will also champion through the chamber to look at that, because that is, individuals in there, and even for Tier 2 and Tier 3, there are still individuals. So we've seen some argument from that perspective that if you remove the veil on the pensions investment, these are investments of individuals, and therefore it must be looked at again. So to the members, yes, for now, the answer is yes, but we will strive to work hard to ensure that some reliefs, if possible, could be given to members, especially those who are on retirement and have kept some funds under the personal pension scheme. Thank you.
Thank you very much, Yao. Is Dr. Gamade back? Let's just quickly check.
Yes, I'm back.
Okay.
I suffered from a temporary. Thank you very much. I nearly got a haircut, but I'm back. So I don't know whether my question was. I don't know whether my question, the question that Jamil asked was heard.
No.
He was asking.
Please repeat.
Okay,
again.
he asked. He said in 2020. Our financial statement or enterprise trustees financial statement indicated that 63% of our investments or pension fund assets were invested into government bonds. His question is, why did enterprise trustee invest as much as 63% in, am I gone again? Hello? His question was that, why did enterprise trustee invest as much as 63% of its portfolio in one single investment category? In other words, risk diversification. He didn't see that. So I want you to explain from the point of view of the investment guidelines and other factors that led to that, so that the participant, Jamil, is appeased.
Thank you very much for that question. And so we are guided by investment policy and guidelines from the regulators' end. So we try as much as possible to derive our investment policy from the investment guidelines that has been issued by the regulator. And in that investment guidelines, government securities upper limit was supposed to be about 75%. And so even doing 63% means that on the whole, we were doing far less than the upper limit, and some risk management process was in place to guide us. In addition to that, we had also the local government and statutory agencies bond, the ESLA Dachi bond, which has been part of this program, which we thought that because it had its own financial arrangement was quite insulated from cash flow issues and stuff like that. So we had some exposure even over there. The issue is that if you look at the investment areas that we had to deal with, as at that time, fixed deposits from banks were giving you a very low yield. Corporate debt too has been an area that had challenges, especially some debt that came to the market that couldn't really fulfill its promises to members, and that's a worst case scenario. So if you want to even go to that area, you have to be extremely careful. There has been some series of engagement with our fund managers, and there are very few corporate debt that they can green, and even that one is based on the fact that it is based on government payroll lending and other stuff largely, so they'll be able to meet their commitment to us. So pushing investment into the private sector was a bit more difficult, and trust me, your investment committee through the board has been looking at that option. As part of it, we also try to diversify and push some monies into alternative asset areas. These are areas that we are monitoring to see how these investments will turn out, and then that will give us much more confidence to even do much more in that area. And I think over the year 2021 through to 2022, we have been having series of engagement with Impact Investing Ghana, trying to look at how we'll be able to touch the real sectors of the economy. And so all these engagements continue to go on, trying to look for safety and also to look for some good returns. So I'm sure it is not out of place decision. As at the time that the decision was made, it was made in the best interest of members. But today, here we find ourselves. And even in this mess, we can see some clarity. And I think we need to also recognize that we have some corporate debt, they keep on tossing us about. But even in this particular mess that we are talking about, we have some clarity as to how we'll be able to get our principal back, and also maybe over the years, some interest. I think the learnings are clear for us, and so we will continue to work with our fund managers so that new funds that we receive will go into the right areas to bring some form of balance and relief to our members. Thank you very much, Doc.
Thank you very much, Yao. And to our participants, I've been scrolling to your questions, and if I don't mention yours, it's just because throughout the discussion, maybe your question has been answered. And so you keep on sending your questions. There is this question from David Opari. He said, he wants to propose to the National Pension Regulatory Authority and enterprise trustees to government on alternatives other than our pensions. He says he has taken the decision to withdraw all his tier 3 immediately. The NPRO enterprise signs onto the debt exchange program. Now let's come to the way forward. Now, I also read other participants say that government should forget about pensions and touch rather MPs or ministers ex gratia, cut down on government size, bring back road tolls and others. I've seen all these questions. But before I go to Isaac on this, what is the way forward, I think that government has come out with a debt exchange program, and it has quantified the amount of savings or the amount of money it would get from in order to aid the debt sustainability analysis of or make our debt sustainable into the near future. So if we are bringing alternative, then alternative must also be quantified. So something is given, something must take, and something that takes also must give us something. So for instance, if we say that government should not touch our pensions, and we are suggesting MPs ex gratia road tolls, what is that quantum? Is that something we can put on the table and bring to government and say, okay, instead of touching pensions to this extent, touch this other thing instead, so that it doesn't have impact the economy. This debt exchange program maybe excludes individual contributors or individual bondholders. Does it mean that the rich and affluent who are capable of affording the purchase of bonds on their own are safe, whilst the very poor pension or average worker who is contributing to a collective investment scheme, or call it pension, is suffering because it is the easiest and the lowest hanging fruit for government to touch? Can we look at other things? So what I'm saying is that whatever alternative you want to bring on board for government to consider must be quantifiable, and we must argue about it. Another even question I was saying that, okay, even the law says that our pension funds should not be touched. So what is NPRA's position on this? Why is NPRA allowing the pension to the way forward? And the way forward is that whatever we are suggesting to government to do in this debt exchange program must be quantified in monetary terms, so that if government wants to take a certain action, we are replacing A with B. I personally would not love, for instance, that accrued investment, or so to speak, accrued interest on all investments generally should not be added to the principal as at the 23rd. If we are saying that, then we should be able to know what quantum of money that is, then how is government going to be able to plug in that hole? Because the fact is, we are in all these together. I've read some of the comments and others have talked, and I see a lot of political sentiments going on. The problem we have now has no political coloration. It doesn't know NDC, it doesn't know NPP. We've gone past the point of finger pointing. Sometimes if you want to save a pint of blood, you may lose your life. So sometimes you have to give a pint so that you can save yourself. That's what the theory and concept of our surgery is. So we are between the deep blue sea and the devil, and our options are very limited. So I think that we have to come to the table with some very, very cogent and tangible, quantifiable suggestions for government to follow. Because if we all take an intransigent position, we may virtually have no country in the near future. And whoever's fault it is not the issue to discuss now. With that small preamble, I want to ask, Isaac, what is the way forward? What do you think we should do about this whole debt exchange program with government? Should we say no, even though there's a poll running? From your own professional point of view, what is your opinion? How do we get government to buy in to our suggestions? And what is the most acceptable strategy to get our pensions not touched or touched briefly or slightly?
Dr. Gawa,
yes, sir.
My KB, which you. I seem to be taking out
I know you are very capable.
Okay,
all the difficult questions.
So, when government is exchanging 137 billion, that's the size. From
yes.
our own analysis, if you compare the cash flow of the bonds that the current bonds that you want to swap with the new bonds, if you compute the value in today's terms versus the new one they are proposing in today's terms, government essentially is saving about 28 or 29 billion, which represent about 5.6%, and in dollar terms probably is equivalent to how much they are getting from the IMF. So you could quite clearly see that this was a condition that they had to meet to get, because if IMF is bringing 3 billion, you probably also need to put the same on the table. Now, the banks hold about 35 or so of the 137 billion bonds that government is swapping. So the banks are the largest holder, and followed by either the pension funds or the Bank of Ghana. Obviously, we know where central bank sits. Obviously, central bank will agree to this term. So if the bank and central bank agrees, then government has more than 50% acceptance rate. The big elephant in the room is the pension funds, whether they will participate or not. Now, it's not in anybody's interest to see a disorganized debt exchange program. It means our currency goes up and things just become, say, well, we lose more in a disorganized way. It's therefore quite interesting that I stand to be corrected. I'm yet to see the Banking Association issue a press release to say they outrightly reject the offer on the table, because we still need to have an organized exchange. So I think it's in the interest of pension funds, banks, and everybody to have an organized exchange. That being said, there are a few things that we could push government back on, and the difficulty with the ones who are holding the bonds, that we don't have as much information as the government. So when somebody says, what's your alternative? If I have the information as government, then I can build a model and say, this is my alternative. But if you present me with your offer, I ask me for an alternative, you are assuming that I have the same information as you. And the mistake we will do is to build a model and an alternative with our own assumption. And then you go and they tell you that this assumption is wrong, this assumption is wrong. Immediately it deflates your proposal. So I have a bit of a difficulty when somebody says, what's the industry alternative? It's not like the industry is bestowed with the same information as government. So based on what government has presented, I think when you look at it quite carefully, the real issue of pension funds are two. One, liquidity. And by liquidity, these existing bonds were quite tradable. You can hold it today, you sell it tomorrow. Okay? So that meant that we didn't need to pack money on the call account waiting for withdrawal. If you need money today and call me, Isaac, I need 10 million today, I can sell a bond for him and he'll get his money. I can sell the bond because when I sell the bond, I'm not crystallizing a loss. Okay? So it made it easy. So pension funds' first problem is the liquidity, in addition to the fact that there's zero coupon payment next year. So liquidity is key. The second fear of pension funds is the real value of the assets. You are promising to pay me 10% almost after 2026 or 2025 onwards. Ordinarily, and thanks to the benefit of playing in other African markets, 10% on a government security is not out of normal. But we have a peculiar situation where we've seen inflation in the double digits in the 19 and 18, and now we're around 50. So our real fear is that by the time they pay me these bonds, the real value would have deflated. So these are the two main points where pinpoint pension funds are. I have not been privy to the conversation that's going on between the chamber and the mayor, but I think that based on these two main pinpoints, question there goes back to government. How do you address it for us? One is the fear of losing the real value. Two is liquidity. And I think that if that engagement can be had and for pension funds to have cogent answers to this, then we may have to look at the whole proposal again and see that maybe with a few tweaks here and there, we should go ahead and let a system run back as it used to be. So for me, I think those are the two things that I would love to see in-depth analysis on from the in-depth response from the government. I hear the liquidity fund as government is proposing, but the details are not out. Obviously, the money will not be cheap. And then how do you protect my value for? All right. Thank you.
Thank you very much, Isaac. And so it means that if I should pick up from what you said, government has not been a bit forthcoming or more forthcoming with the facts. And maybe we would have to ask government to bring those facts on board, because if it's going to be voluntary and it has to be an exchange between us and government, we should have all cards on the table, and then we'll discuss the alternatives and look at the whole model. Because the thing about it is, and one person asked, what will be the impact on the average pensioner and contributor in terms of how people will feel like? Now, everybody begin to think that apart from the compulsory ones, maybe I better keep my money in a savings account or somewhere and manage it myself. The impact of this debt exchange program is going to be significant. But again, as you rightly said, sometimes if you push for the little things in life and you want to stretch so much on your right, you may lose your left hand as well as the right hand. And that is where we are now. Yeah, what is your concluding remarks? What's the way forward in your concluding remarks for all the participants who are listening? They want to listen. And please, let's inspire some confidence into our members as well. But from the questions I've seen, a lot of people are afraid that if government goes ahead or we are compelled to sign the debt exchange program, then they are prepared to exit the various schemes and there's going to be a run on our scheme. What assurance are we going to give to our members in this regard as part of your concluding remarks? Yeah.
All right. Thank you very much, Doc. So we will say to members that they should remain calm. And the fact is that the entire company, the trustee boards, the chamber, to the extent that we are even, subscribing to advisory services to help us to be able to properly engage with government, should give them confidence that we mean business and we want to negotiate on their behalf in terms of our fiduciary responsibility, because we know that, we are doing this for them, so they should remain calm. The other question is, should they continue to invest? Yes, you have to continue to invest. I always say that the alternatives that seems viable today, tomorrow may not be viable. And therefore, having a well-diversified portfolio in which risk are managed will be the best way, to manage some of these things. Today, maybe keeping your money under your pillow will be the best option, but tomorrow it might not be the case. And so members should remain calm. We empathize with the situation. Ourselves, we are affected as a business and as individuals, but we need to carefully engage with government and then ensure that at least something good will come out of this engagement that will be acceptable to all our members. We have to do some sacrifice. There's no two ways about that. But the point is that when it is too steep and it is like one-sided, then that becomes difficult. But we are very optimistic that government will listen to our plea and make some concessions for us. So to members, I say that don't go and withdraw your fund. There is actually no market now for us to even realize this investment and to pay you. So that will bring a run. We will really cause a real mess for ourselves if we take that position. And I will say that please, please don't let us do that. That will kill the entire industry. And so don't let us do that. It's painful, it's difficult. We accept, we empathize, we appreciate, but we feel that when we work together with your support and with you backing us, we'll be able to get something good out of this situation. Thank you very much, Doc.
Thank you very much, Yao. And then my last question goes to, my last set of questions has to go to Kwabena. First of all, a questioner just asked that given what with the benefit of hindsight, are we going to MPRA to tell them to look at the asset class allocations and ensure that we don't put so much of our monies or the assets into government instrument bonds? He thinks that 65 to 70% of asset portfolio in government bonds now and into the future should not be the way forward. That is number one. Number two, you'd also realize that the Bank of Ghana and for that matter, SEC, have rolled out a lot of relief packages for banks and other institutions regulated by SEC. The Bank of Ghana has, for instance, reduced the cash reserve requirements. It has asked for some reduction in capital conservation. A whole lot of buffers have been provided to save the organizations. And similar thing is being rolled out from SEC's point of view. One person is asking, why is government ready to save the institutions, but appears to be sticky on bending back to save the pension contributor? Because without the contributors, those institutions would not exist. So it appears that, what's your opinion on that? And then finally, your concluding remarks on the way forward. So 3 in 1.
Thank you, Dr. Gawani. Isaac, I think you've gotten your revenge. Yes. I think in one of the engagements with this debt restructuring with the regulators in one room, one thing was very clear, that the regulatory regime that we had prior to this debt restructuring or exchange must change going forward, given the new debt instrument that we are going to receive. It has implications on even our capital as institutions. And therefore, one word which all the regulators used was forbearance, and then a reconstruction of the regulations that we have as is. The kind investment guidelines actually provided, and I'm sure the corporate trustees were working towards constituent funds, where we're actually going to put all the investment or all the funds of retiring people into Government of Ghana securities. Those aspects of the regulations are being re-looked at. So there's room for the regulator to reconsider the investment guidelines that they have given us, that we used to run with, giving the new lessons or the lessons that we are picking up. One of it is knowing that Government of Ghana securities is not as risk-free as we thought it was. So given the fact that there's now some element of risk with Government of Ghana securities, are we still going to see those high allocations that we usually have? I think the answer will be no. So definitely there will be some room for changes as we go forward with the guidelines. Then on the directives or the considerations that Bank of Ghana has given to the banks, I think it's mainly boils on our ability to run as a country and as an economy. That is very fundamental. I mean, like I use as an example, if you owe, the company owed a bank and you're going to restructure, one, it's either the company is refusing to pay or cannot pay. If it's refusing to pay, then you can use all manner of means and take your money. But if it cannot pay, then you're looking at how do I keep the company running so that they can still pay me? So how do we keep our banks alive so that they can still support?
Kwabena, sorry, I'll make this into Kwabena.
Okay.
Sorry, I want to make this into, because when you brought that analogy, one participant raised a very critical question. He says, this time around, it's not I who owe the bank. The bank owes me, and the bank is determining how they want to pay me. So your analogy is that they don't agree with the situation that we owe the bank. The bank owes us, and the bank is now determining how they will pay us. And for him, he doesn't see eye to eye with this arrangement at all. What is your point about that?
Yeah, so it's all coming from the debt restructuring. It is the impact of the debt restructuring that is making the banks now come to clients. And so if it hadn't been the debt restructuring, we wouldn't have the situation. In the same way, I mean, I would say that they are coming back to clients and telling them that calm down, don't withdraw now, because withdrawals will have an impact on the fund, because then we need to sell securities or investments which may come at a punitive price and will impact on the entire valuation of the fund. So it's the effect of these debt restructuring that is leading to these conversations. So in the light of that, we're looking at survival, our ability to continue to exist. In the same way as a fund, it's important that all investors calm down and then hold on with these withdrawals and let's see how the funds can be restructured to ensure that one person leaving doesn't impact the future of the entire fund. And I guess my closing remark will be the fact that the economy needs a reset, which is very fundamental going forward. We've had periods of very high interest rate inflation and depreciation. It will be good for all of us going forward if the economy is reset such that we begin to see interest rates inflation below 10%, so that we can boost development in the real sector or growth in the real sector that will add value. And then also with diversification from the pension schemes, we will be able to invest in the real sector, reignite the economy, and see more value add to pensions, not from giving monies to government, but actually from impacting the real sector of the economy. And I believe that once we see this happening, unfolding as we move forward, there'll be calmer, and investors or pensioners can hope for a better value going forward beyond what we have seen today. Thank you.
Thank you very much. And I think all my panelists deserve a huge and thunderous applause for delivering on the subject matter. There are a lot of questions that have been asked. Some, I hope that the enterprise trustees would handle some of the questions and give you feedback. Others are asking about challenges they are facing, updating their records, and that they can't do some logins. A lot of complaints have come from persons who will be retiring next year, and they want to be assured what the extent of the impact of this thing will be on them. I'm sure our panelists have answered them. In fact, the impact will be specifically to persons individually. But what I also have to say in concluding is that when you have a cancerous situation, the process of curing it is usually tough. Going through chemotherapy and other cancer treatment process requires a lot of pain and sufferings, endurance, and everything. We are all in this together. As Yao said, I think Isaac really said it, that if in fact it was Yao who said that if you really go out there and want to withdraw your money, you may not have any alternative place to put it. If you put it under your pillow, you can have the assurance that sometimes a rat somewhere will come and pick it. I saw a video somewhere recently where some amount of cash was stashed somewhere, and before they realized, moth and other things has eaten the money up. So usually your safe bet is to keep your money in these kinds of investments, so that eventually with the passage of time, everything will be well. So time heals, and we hope that with the passage of time, everything will be well. At this point, I want to hand over to the moderator, Doreen. At the beginning of the program, we're supposed to have the MD give us some opening remarks. I'm sure by this time, he would have revised his notes to address some of the questions. And so he would include in his introductory or welcome remarks some other issues that have to be addressed as a result of questions.
Thank you very much, Dr. Gamade. Over to you, Joe.
Good afternoon, members and my dear clients, colleagues on the call. It's been a very engaging session. Apologies for the tech issue that I experienced earlier, but sometimes I'm sure God has his ways of having to set the tone. So it's been a very engaging session. I've seen the kind of questions that have come up. Dr. Gamade and the team have tried to give some feedback to some of the questions. But there's one thing that I just want us to leave here with, that Enterprise Trustees is a member of the Chamber of Corporate Trustees. And the Chamber of Corporate Trustees has assessed the debt exchange program in the current form and the structure that it is. And quite clearly, when we all did the analysis, the kind of impact that it will have on members is what we are trying to mitigate. And therefore, in this current form, we have politely indicated to the ministry and to our regulator that we cannot sign onto the program. We have, the chamber has written to the Ministry of Finance essentially to extend the deadline, largely to afford there to be a domestic bond committee, which would then engage appropriately on the proposals that have come forward. Like Dr. Gamade rightly said, we want to be able to understand the method of treatment and then also have a say to how at least that treatment can happen. Some organized labor as well has rejected this totally, and are even indicating that pensions should not even be touched. But at the end of the day, we're all trying to seek a fine balance on the way forward. So rest assured, members, I looked at the poll and that was conducted, and quite clearly, a large percentage are also not in favor. So we would continue to judge with the regulator, the MPRA, and also the Ministry of Finance as far as we can get to, as far as the debt exchange program is concerned. This is our Ghana. We don't have any other country, but then we also want to be sure that at the end of the day, members hearing and all those who are retiring within the next 10 years can also do so without a serious adverse effect. The main issues that have been raised, and I think Isaac summarized it, or was it KB, regarding the zero coupons and also the fact that no interest, the interest accrued would also be lost. Pensions largely depend on the compound effect. And once there's a distortion one way or the other, it sort of like goes to affect us going forward. Liquidity is also would also be a challenge. Right now, today, as we speak, we don't have a secondary market that is in operation. And quite clearly, we do have some tier 3 benefits that are currently awaiting funding. And that is something that we are having to deal with as we go along. But rest assured that management, the board, and everyone is quite upbeat about this. But we are also very clear in our minds that we would seek the best interest of every single member on this call. Some of us are in the thick of it. We also have a few years to go to retirement. Dorian, you have a lot more. So, but quite clearly, we're also very interested. We're also very interested in how this journey continues to unpack. So, members, please rest assured that these kinds of engagements will do more of it. I find it very useful at the end of the day because it gives us management a sense of how members feel on certain things and how we can even better ourselves as we go along. Very interesting revelation when one of the members did a review of the financial statement and pulled out and said a massive investment in GOG. Today we are where we are, but I think 2-3 years ago, and for some of us who started this as far back as 10 years ago, GOG, Government of Ghana, has always been risk-free, has always been an area where any investment will simply put its money to ensure that come a rainy day, definitely we would be able to see it. So quite clearly, the trustees have have done their very best in ensuring that for safety and everything else, that was exactly where it went. But also looking at the design of the pension scheme that we follow, quite naturally, a majority of the assets would always sit in GOG. So yes, going forward, the regulator has indicated and has set in motion some reforms that will take place, such that other investment classes can also be upped up, rather in a way to say that to reduce some of the limitations that would exist for us to be able to invest in GOG. So members, I would just like to give you the assurance that we are working for you. I mean, every single bone in my body, every single bone in my team's body, everything that we are doing is largely to ensure that we are trying to deliver at our utmost best for your benefit, because it is when you succeed, it is when you retire properly, it is when you walk out the door smiling, that is when we have some peace within us. So we will do all the engagements that we need to do as far as is concerned. Just to give you some, I mean, in terms of the signal, somebody said, how come we didn't see this coming? I mean, it has been coming, but then the question is that the treatment of it, nobody knew the level of restructuring, the manner within which the restructuring was going to happen. We had setting forth a process to be able to do the engagement. Unfortunately, that process was also not too revealing to the extent of engagement to give us a sense of how can this, what could we have done. But as far as we're concerned, based on working with our investment managers, there are quite a few things that we try to do just to be able to even work from the depreciation point of view. And that's what Yao indicated regarding the investment in Eurobonds and others. So rest assured that we've been on the beat. We've done quite a lot. And I'd like to thank all my colleagues, all my team members who work tirelessly behind the scenes just to ensure that we can at least bring some level of appreciation or comfort to members. So please rest assured, we are with you. We will continue to take feedback. Please feel free to reach out to any of us at any point in time, and then we'll see how best we can be able to move on. But like we are saying, the law did say that on the tier 3 funds, yes, on the 10th anniversary, ask yourself, this is a retirement fund. Yes, there are some vesting rules, and I know that Christmas is also around the corner. There are certain obligations that we do have, but unfortunately, based on the current market, it is very difficult to find liquidity, and that is what we are trying as much as possible to ensure that we can at least focus on retirement benefits for now. So I would entreat all my members around the 10th anniversary and partial withdrawals and others just to give us a little bit of time for the dust to settle, such that the market can be upbeat and that we can continue to be able to service you. But for retirement benefits, yes, it's also, we are trying to see how best we can manage it within the contribution levels that come through at the moment. So ladies and gentlemen, it's a tough time, but I believe that, well, with Christmas around the corner, we would, Christ is born, and definitely we would see some light. The 3 wise men are coming, so very soon we would see some light. Thank you so much.
Thank you very much, Joe. That's the Managing Director for Enterprise Trustees. Thank you very much for your words and for the assurance that you have given our members as well. And so we come to a close for today's session. We especially want to thank our panelists, Mr. Kwabena Boama, Mr. Isaac Boama, Dr. Frank Gamade, our moderator for the day. Thank you very much, sir. We are grateful. And then also to Mr. Yakusie Champong for the support. So for now, we would want to take the closing prayer and then we'll be out of here. Thank you very much also to our cherished clients who joined us on the session. We could not have done this without you. Thank you very much for the support. And we hope that there are brighter things to come in the future. Thank you very much. To give us a closing prayer, I would like to invite Amos Esirifi to give us the closing prayer.
Shall we pray?
O Lord, you who have been our help in ages past, Father, we believe that you are still our strength in these difficult times that we find ourselves. And you will remain our hope in the times ahead of us. Lord, we thank you for making this discussion possible. We pray and ask that, Father, if there are any solutions, if there are any measures that we have never thought of, Lord, redirect our thinking in that regard. We commit any further engagement with relevant authorities on this subject in your hands. We believe that, Lord, that which is impossible for you does not exist. So we commit all such engagements that, Lord, at the end of the day, a decision that will endure to the benefit of all will be made. We thank you and we commit the rest of our day into your hands. Continue to bless us and continue to keep us safe. We have asked this in the name of Jesus Christ, your Son. Amen.
Amen.
Amen. Amen. Thank you very much. And have a good afternoon.
Cheers.
Thank you.
Bye-bye.
Bye.
And Merry Christmas.
Merry Christmas, everyone.
Oh, yes.